Why did Buffett buy so much Apple? And more importantly, does it still make sense to hold the stock today? In this video, we're breaking it all down. What Buffett originally saw in Apple and why it shocked the market. What's changed since then? iPhone growth, China risk, services revenue, valuation. Whether Apple still passes Buffett's 4 classic filters. And most importantly, what he sees that most investors don't and what you can learn from it. Because maybe it's not about the iPhone anymore. Maybe it's about how Apple prints cash and buys back shares like no other company on earth. Let's get into it. Well, in 2016, Warren Buffett did something that went against everything he had said over the previous 50 years.
Have you ever bought a technology company?
No, I really haven't.
In 30 years of investing, not one?
I haven't understood any of them.
And so here is this technological revolution going on, and you're not going to be a participant.
Gone right past me.
Is that all right with you?
It's okay with me.
He bought stock in a tech company, Apple. Yes, the same Buffett who always claimed he didn't understand the tech sector, who preferred predictable businesses with clear competitive advantages and strong management teams. But that year, quietly, Berkshire Hathaway started buying Apple shares. The first batch was around 9.8 million shares for just over $1 billion. At the time, nobody really understood it. Only later did the story come out. The initial move wasn't Buffett's idea. It was his 2 investment managers, Ted Weschler and Todd Combs. And when Buffett saw what they were doing, he doubled down. Today, nearly a decade later, Apple represents about 21% of Berkshire's entire stock portfolio, according to the latest data from CNBC, July 2025. That's more than 300 million shares, roughly 2% of the entire company, with a market value north of $66 billion. And the most impressive part, that position started at an average adjusted cost of just $39.63 per share. Today, Apple trades around $213 per share, a gain of approximately 438% on the original investment. In other words, what once looked like a contradiction to Buffett's philosophy became the single most profitable investment in Berkshire Hathaway's history. And according to Buffett himself, an even better business than it first appeared. But why did he do it? Buffett wasn't buying technology. He was buying something much rarer, a company with an irreplaceable brand, insanely loyal users, and the ability to print cash year after year, even without launching anything revolutionary. To Buffett, Apple wasn't a smartphone maker. It was a consumer company with an emotional monopoly, something he compared to Coca-Cola. Predictable, recurring, and with unbelievable pricing power. And most importantly, a massive buyback program that makes Berkshire's stake more valuable, even if they never buy another share. While the market saw a tech company, Buffett saw a cash register with a margin of safety, and he wasn't wrong. Now what's changed since then? When Buffett started buying Apple, the company was riding the iPhone wave. Growth was explosive, China was booming, and no one questioned whether Apple could reinvent itself. But almost a decade has passed, and a lot has changed. Almost a year ago, Wall Street learned that Berkshire Hathaway was selling a significant portion of its Apple stake, which had long been its largest equity position. Apple isn't just another holding, it's one of Berkshire's 4 giants, as Buffett once described, a pillar of the company's business model. But by the third quarter of 2024, Berkshire had sold 100 million shares, reducing its stake to 300 million. Apple now makes up 26.2% of Berkshire's equity portfolio, down from nearly 50% at its peak. At the May 2024 shareholder meeting, Buffett explained the move. They were selling for tax reasons. But even after that announcement, the selling continued, raising questions about whether the thesis had changed or whether Berkshire was simply trimming exposure. And part of the answer might lie in one word: China. In 2025, Apple's sales in China fell 11% year over year in the first fiscal quarter. And in May alone, foreign smartphone sales, including Apple, were down 9.7%. Local brands like Huawei surged, fueled by nationalistic momentum and government support. To respond, Apple slashed the price of the iPhone 16 by as much as RMB 2,530, around 350, to defend market share during the 6.18 shopping festival. It helped briefly. In June, Apple posted its first iPhone sales growth in China since 2023. But volatility is the new normal. China, once the engine of growth, is now the epicenter of risk. And that risk isn't just about sales, it's also about production. Over 90% of Apple's products are still manufactured in China, leaving the company exposed to trade tensions, regulation, and tariff threats. With U.S. elections on the horizon and tariffs of 25–30% being discussed on Chinese imports, Apple's margins could come under serious pressure. This matters because Buffett avoids uncertainty, especially geopolitical and regulatory uncertainty. He's said many times that he doesn't like investing in businesses where governments play too large a role in outcomes. Apple used to operate in a relatively safe zone. That's no longer guaranteed. Meanwhile, Apple's services segment continues to grow, with revenue expected to reach $108 billion in 2025 and gross margins exceeding 70%. It's no longer just a hardware company. Apple is becoming a cash flow machine powered by subscriptions, platform fees, and ecosystem lock-in. That's exactly the kind of business Buffett likes. They're also making moves in AI. Apple Intelligence was launched in 2025, but its rollout in China was blocked due to regulatory issues. To bypass that, Apple partnered with Alibaba to tailor the tech for Chinese users. And behind it all is the silent engine: stock buybacks. In 2024, Apple authorized a record $110 billion repurchase program. That means Buffett's ownership share grows, even without buying more. It's quiet compounding. As he says, when the share count goes down, your interest in the business goes up. So what's changed? Apple's no longer just the iPhone company. It's a mature platform managing global risk, building service-based resilience, and returning cash to shareholders. The thesis still works, but it's being stress-tested. And today, it depends less on how many iPhones are sold and more on how well Apple navigates a divided world. Now, in the third part, Buffett has always said he uses 4 key filters before investing in any company. First, he has to understand the business. Second, the company must have a durable competitive advantage. Third, management must be competent and trustworthy. Fourth, and the price must make sense. Simple in theory, hard to find all 4 at once. So the question is, does Apple still pass these filters in 2025? Let's break it down. The first filter, understanding the business, still holds. Apple is more predictable today than it was in 2016. The user base has expanded, services have scaled, and revenue is highly recurring. The company is less about breakthrough innovation and more about retention. And for Buffett, that's even better. He likes businesses that run like clockwork. Apple's ecosystem, iPhone, iCloud, App Store, Apple Pay, gives him exactly that. The second filter, competitive advantage, might be stronger than ever. The iPhone has one of the highest customer loyalty rates in the world. Over 90% of users stay with Apple. The brand is an emotional monopoly. The switching cost is huge, and the user doesn't even feel it. If you own AirPods, an Apple Watch, a Mac, and use iCloud, leaving that ecosystem is inconvenient and painful. On top of that, Apple controls its entire experience, from hardware to software to payment. That's a moat, and it's hard to copy. The third filter, management, also remains solid. Buffett has said he considers Tim Cook one of the best CEOs out there, not just for operations, but for capital allocation. Cook has delivered consistency, margins, and record-level buybacks without flashy acquisitions or unrealistic promises. He's not the visionary that Steve Jobs was, but for Buffett, that's not a problem. He prefers steady operators to unpredictable geniuses. The only real question is the fourth filter, price. Back in 2016, when Berkshire started buying Apple, the stock traded at a PE of 15. Today, it trades closer to 30 times earnings, depending on how you calculate it. That's high, not just by Apple's historical standards, but for Berkshire's portfolio as a whole. So yes, Apple is still a great business, but the price demands faith. Buffett continues to hold because he bought at a much lower valuation. His margin of safety is baked into the entry price, not the current one. But if he were looking at Apple for the first time today, he might hesitate. Or as he'd probably say, we don't like to pay too much even for wonderful businesses. Apple is still a wonderful business, but it may no longer be on sale. Okay, so let's recap and build the final conclusion. Warren Buffett bought Apple for around $35 billion, right? Today, even after selling 100 million shares, Berkshire's position has generated over $166 billion in total value, including dividends, stock buybacks, and appreciation. That's a total return of more more than 370% in under a decade. Mathematically, it's the most profitable investment in Berkshire Hathaway's history. But what about now? Apple is trading at roughly 30 times earnings, well above its historical average of 15 to 20x. Revenue growth is slowing, and geopolitical risk has never been higher. If you were applying Buffett's 4 filters today, the same way he did in 2016, Apple wouldn't pass all 4. Great business? Yes. Strong management? Yes. Fair price? Probably not. And that's exactly why he started selling. Buffett bought when Apple was obvious, but ignored. You're thinking about buying when it's celebrated and already priced like royalty. Here's the math. If you already own Apple at a good entry point, holding might still make sense. But if you're buying now, you'll need a much better reason than Buffett owns it. Because what made Buffett so much money was buying an excellent company at an excellent price. Today, Apple is still excellent, but the price, not so much. Well, that's it, cousins. Stay invested.